this evening. Our first keynote speaker is a titan of market forecasting. Blu Putnam retired in December of 2023 as a managing director and chief economist of CME Group, the world's largest derivatives marketplace. During his storied 12-year tenure at CME, Blu spearheaded economic research and data science, becoming a globally recognized authority on structural market shifts and macroeconomic policy. Today, he remains a leading independent strategist, helping investors navigate the complex intersection of global economics and business fundamentals. Please join me in welcome Blu Putnam.
We're going to talk today about several different things. I'm going to cover the Iran war. One more. Yeah, we're going to go talk about the Iran war a little bit. We're going to talk about AI. You've just seen how AI hallucinates. We'll talk about how AI is disrupting markets. And then I'm going to finish on the Federal Reserve. We're going to have a new Federal Reserve chair, and he's going to be way different than the last chair. And I want to tell you how it's going to be different. We know interest rates aren't going to change anytime soon because of the inflation pressures, but the Fed's going to change. So let's go to the next one. When we're thinking about the Iran war, I don't think economists do a very good job of analyzing it. And the main reason they don't is the economists don't tend to think in the way of complex systems. So I'm always fond of this quote. This is a picture of John Muir and Teddy Roosevelt from 1903. John Muir was an environmentalist, one of the early ones. They helped set up the national parks. This is in Yosemite. But what John Muir said is if you touch anything, everything is affected. And that's what really is happening with the Iran war. Okay, next one. So we know that oil prices have gone up. Everybody knows that. Next. We know that gasoline prices have gone up. Next. But, nope, that's not it. Sorry, I didn't know what my slides were. But what is really happening is that we've affected gasoline. Diesel fuel is up more than gasoline. Jet fuel is up more. We've also impacted helium. You can't make a computer chip without it. You can't get a good MRI. All of these things are being impacted by what's going on in the Strait of Hormuz. And by the way, there was an off switch. They could turn the oil off, but there's no on switch. It's going to take many, many months and probably even a year or two to get back to normal. But you won't go back to normal. Normal is a fiction of your history, your own imagination, what you've lived. One of the theorems in physics that I really like is something called the arrow of time. And basically what that means is when you get a big shock, and this is a pretty big shock, there is no going back to where you were. You're going to find a new equilibrium. You're going to find a new way of doing business, but it's not going to be the same. By the way, if you want to understand the arrow of time, you can pretend I'm a really good skier. I'm an intermediate skier. Every now and then I make a mistake and I go to the expert slope and I sit there for about 5 minutes thinking, what am I doing up here? But what I will tell you is that once I push off, I am not going back the way I came. I'm going down one way or the other. And that's the arrow of time. So when we're thinking about what's going to happen, the new theme is going to be resilience. A lot of the things we did in supply chains, we kind of learned about this in the pandemic, was we used to create our supply chains to be the lowest cost. Now we're going to create them to be resilient. That means having more than one supplier. The Saudis are going to probably put in a couple more pipelines to get their oil to the Red Sea. Iraq, Kuwait, maybe you will get a pipeline to Turkey. They're going to look at all kind of different ways. And of course, people on the other side of that are going to be looking at how can I diversify my supplier. So we're going to be very, very different. The other thing is, but we all know it's going to cause some inflation. I don't know about you. When I go to the gas pump, and I have a fairly small car, but my wife has a gas guzzler. When the first time it hit $100, I just started going back and filling it up at half tank so I wouldn't have to ever see that number again. It's going to take us, it's going to be a temporary inflation, but temporary is going to be like 18 months. So The last time the Fed used the word temporary, they got kind of bitten by it. I think this time they'll learn. Okay, a little bit more on what's happening to farmers. We're in Nebraska. I got to talk a little bit about it. We've really upset the price of fertilizer. So farmers have to deal with having to pay a lot more for fertilizer. But farmers here also have to deal with a drought. This is the University of Nebraska's drought monitor. And the yellow and the red is not a good thing. And so when you're dealing with drought and high costs of fertilizer, you're going to have to plant your fields. As the senator reminded me, you're going to have to pay taxes. You got to do some things. But you've got choices of which crop to plant. Nebraska's biggest crop is corn. But the second biggest is soybeans. Anyway, soybeans take less fertilizer than corn. Who knows? We might see a few more acres of soybeans this year. So I'm just trying to make the point that everything has been affected. The choice that a farmer in Nebraska makes has changed because of the Strait of Hormuz. Next. So we're going to talk about, last thing, just summarizing, you got to understand complexity and you got to understand the era of time or you're not going to get this right. Now we go to the next one. Now we're going to talk about AI. How has AI disrupted markets? So one of the ways we've seen it, the stock market has come all the way back. It's at record. The S&P's at record highs. It's almost like nothing has happened. But a lot has happened under the surface. If you look at the stock prices of software companies, this is software as a service, Salesforce, customer management software, their stock price has been killed and they're making big money. It's not their revenue and their profits that are the problem. It's the stock market thinking about what's going to happen to their future growth. They're worried. The other one down there is Workday. That's your HR systems and stuff. If you get paid, you probably use, you may not like Workday, but you probably have interfaced with it. Anyway, they've been killed too. And why? Because people think, market participants think, that AI will allow new startup companies to do what these companies do cheaper and maybe more customized. But these companies are making money, but their future profit growth is not likely to be what we thought a year or two ago. So we've got the disruption. Next slide. We also have disruption of the companies that provide private credit and private equity. These are companies like, Blackstone's not up here, but Blue Owl is a big one on private credit. Ares is a big one. So even if you're a public company that invests in private investments, your stock price has been hit. Now, the point here, though, is what we're having to see is that people didn't really understand what some of these private investments were. To me, I'm an options guy. And when you buy a risky stock, you are actually buying a call option on the underlying assets of that company. Next slide. But when you lend money to that same risky company, you are writing a short put option. What this graph shows out to the side there is that you're going to get paid a premium as long as that company is doing pretty well. That premium is going to be the interest rate on your private credit loan. But if the company doesn't do so well, in fact, if in the worst case it goes bankrupt, they're going to put the company back to the lender. So a lot of people I talk to on investment committees that think, wow, we've got to get into private credit. We've got to get into private equity. By the way, I'm on an endowment committee, and we are in it, okay? So I'm not opposed to being this. I just want you to understand what you're doing. You're taking a lot of different risks than you're expecting to take if you just listen to your salesperson. Next. So here's the kind of risks that we face. One, you get a lot of concentration. You may ask, why did these investors get so hooked on software as a service? The answer is that a lot of software as a service companies are private. I picked out a couple of public ones, but there's some big private ones. And they're big enough so that when you have $1 trillion investment fund or $100 billion, the Blackstones and the Ares and the Blue Owls, they can get a big enough slice to make a difference. They're not going to be looking at smaller things. So they went for the big guys and they ended up here. Another thing you have is we had so much new money in the last decade flow into private equity and private credit that guess what? The talent pool for managing that money got degraded. That's the law of diminishing returns, in a way in economics, but it happened. So you got to be much more careful picking your managers. We already know about the options, and then there's an asymmetry in valuation. When we're on the upside of the movement, most of the private equity companies are valued based on their last capital raise. So they can be worth way more than what the valuation shows up. But on the downside, they don't get downgraded as much. I think Warren Buffett may have said something about mark to myth, I believe it was. Anyway, the last thing is, if you are buying a fund that's full of illiquid assets, your fund is illiquid. And we learned that in the last couple of weeks. So that's AI. Next. Oh, I like to quote George Soros. Basically what he said is you make the most money when it goes from god-awful to awful. This is attributed to him, but I never could find the exact citation, so we don't know if he actually said it. But by the way, I do think the software as a service and the private equity and the private credit, it's had its comeuppance, and we're going from god-awful to awful. Okay, next. Now we're going to talk about the Fed, one of my favorite subjects. My very first job out of graduate school was Federal Reserve Bank of New York. And the reason that I got that job was because they hired a lot of economists. I don't know if that's a good thing or a bad thing, but they hire us when we have zero experience. Anyway, that's the way it works. So let's talk first about the dual mandate. What's the Fed thinking right now? And then I'm going to tell you all the changes I see coming. This is the unemployment rate. We're fine if you just look at the unemployment rate. Next slide. This is jobs. By the way, job markets, this is your monthly employment report. Jobs tend to be quite a volatile series, so I smooth all these things out. I smooth them out in an interesting way, by the way. I use a time decay process. I believe that the recent data is way more valuable than old data, and I don't like statistical techniques that value old data the same as new data, so that's what you're seeing here. But anyway, what this says is we're really not hiring very many people anymore. We're not firing them, we're not hiring them, we're in a very interesting place, but it's not a really great place. So there's some issues on the economy. Next one, let's look at inflation. This shows it from 1955, but you can see we've come back from the pandemic. Next slide. We've come back from the pandemic, but we kind of got stuck at 3%. We were 9% on the CPI. We came down to close to 3, and then we just couldn't go any further. But the Fed doesn't look at the CPI. By the way, we all do, because that's the headline number, and it comes out in the middle of the month. The Fed looks at the core number from the PCE. Next slide. And that one, 3.2%, well above the Fed's 2% target. So if you're thinking about what the Fed is doing, they're not going to be lowering interest rates during this inflation episode that we're seeing. It's just not likely. Next. By the way, if some of us look at monthly data, if you want to have 2% inflation, you've got to have much lower monthly inflation than we're seeing. So that's not working. Next. Treasury, this is a slide of the 10-year Treasury. You can see it's gone up. The yields have gone up. It's talking about inflation expectations. We know that those have gone up. Next, federal funds rate. We were lowering it. We've stopped doing that. By the way, that period there from 2009 to 2020 where we were at 0, if that's your historical experience, like if you're 35 years old, you might as well kiss that goodbye. That's not coming back. So your historical experience isn't going to work. Next, and this is the federal funds rate futures market, and we're looking out to the middle of next year. And so it's the implied interest rate. If you go back a couple of months, we thought it was going to be 3% next year. Nope. Now we've given up on that. We'll see how. By the way, futures markets, we sometimes talk about them in terms of expectations. They're almost always wrong, okay? Futures markets do a terrible job of predicting the future. What they really are is the price of risk management. If you're exposed to this, how are you going to lay off exposure? You've got to find somebody that wants to take a speculative position. So don't always think about them as being accurate because they aren't. Next. So how are we going to change the Fed? Kevin Walsh was a Federal Reserve governor, and he's going to be the new chair of the Fed. or at least we think so, starting on May 15th. So there's some issues here. Jay Powell has a Board of Governor term that runs to January 31, 2028, and he told us Wednesday that he's planning on staying around. He's worried about the independence of the Fed. I don't know how much you know about the Fed, but the building at the Federal Reserve is called the Mariner-Eccles Building. Eccles was a Fed chair back under Truman, President Truman, right after World War II. Truman did not reappoint him as chair, but he stayed on because his term was still on. And he stayed on for the same reason. Truman wanted the Fed to take its policies from the Treasury. And Eccles did not want that. And eventually in 1951, they had an accord, and the Fed got its independence, and it's held it at least till now. So Jay Powell, every day he goes to work, he walks under that Eccles building sign. I'm not surprised he's hanging around. I'm sure he doesn't really want to hang around, but he is going to hang around. So what's going to change? I'm sorry. You can kill all the slides now. What's going to change at the Fed? The first thing is Walsh doesn't like forward guidance. He thinks forward guidance limits your ability to do things. So the forward guidance that Ben Bernanke started and Janet Yellen continued, Jay Powell used, going to be gone. So we're going to have a lot more volatility ahead of a Fed meeting. Kevin Walsh doesn't like quantitative easing. Now, he was okay with the quantitative easing in 2008 when we had the Great Recession. The part he doesn't like is the quantitative easing after the economy started to grow, 2010, 2011, and so on. So he's planning on shrinking the Fed's balance sheet. And what that means is that the Fed will also be a little less active in money markets, the overnight money markets. So banks are going to have to do a better job of managing their day-to-day funding risk. So the Fed will no longer be in loco parentis, replacing your parents, so to speak. Going to be a very different Fed. And then my last point on the Fed is he's going to shrink the research staff. Anybody want to guess how many professional economists work at the Federal Reserve Board in Washington? I'm not talking about the regional Feds. 400 PhD economists. Go back to 2008, it was less than 200. Okay, when I joined the Fed, it was less than 100. I didn't work at the board, I was in New York. We don't need all these economists. That's Kevin Walsh's position. I don't always agree with Kevin Walsh, but I'm going to buy into that one. So anyway, that's the last change. If you're an economist at the Federal Reserve, you might want to use AI to get your resume ready. Anyway, there we go. Thank you very much.
The redemption of your private credit holding of your endowment, and why?
So we have a 5-person committee on this. By the way, the endowment is a little college called St. Mary's College of Maryland. A former professor there was Norton Dodge. Norton Dodge's father was Homer Dodge, and Homer was the very first non-family investor with Warren Buffett in the mid-1950s. A friend of mine wrote a book about this. He asked me to be a co-author. It's called The Apprenticeship of Warren Buffett. Nothing about investments. It's all about the friendship that Homer and Norton Dodge had with Ben Graham and Warren Buffett before Berkshire Hathaway. But back to your question, private equity, private credit gives you the ability to earn a premium over time, over public markets, but time in that case means really long, like decades, because things work in cycles, and we're going through a cycle now where public markets are maybe a little better than private markets. But when we had zero interest rates there, you really wanted to be in the private equity and private markets. So we just go through cycles on that. And if you can tell, I'm actually optimistic and I'm ready to expand the investments in those sectors today. But about 6 months ago, I voted against an investment in those sectors. So, as I think John Maynard Keynes said, when the facts change, I can change my opinion. The facts have changed. We've gotten the comeuppance from that sector. And now we're ready. We've cleared it out. What did Warren Buffett say? You don't know who's swimming naked until the tide goes out. Okay, the tide just went out, and now we're ready to go back in. So, yeah.
All right, thank you.